Okay, welcome everyone. Good morning, evening, and afternoon to our attendants and followers. Thank you very much for joining in today. I'm Giuseppe Basile and will be your host today. This is part of our weekly show on FX Street. This is the FibStalker FX Street weekly show, and this show is held every Wednesday at 7 p.m. EST. And the show is typically organized in two parts. In the first part, I do an assessment or I introduce a fundamental analysis, or I touch on a specific educational topic. And in the second part, I review a group of Forex pairs. So today I'm going to make an assessment on the S&P500 equity index. It appears that everybody seems worried about what's going on, what started last Friday. It's a move lower. We get them. It's pretty normal. We'll try to make an assessment here of what we should anticipate. I will talk about the levels that you should watch, and as always, I'll provide information and charts. So the common risk applies, and as you know, risk is very important. For me, it's trader's job number one. So if you are watching the recording, please stop it here and make sure that you understand the risk statement here. I won't talk about myself. If you want to look at my bio, you can find it in a number of presentations I've given on FX Street. But anyway, I'm listing my background here in this slide, and I collaborate with a number of companies and agents and shows on a regular basis. I'm also a premium contributor to FX Street, and I'm also involved with the Canadian Society of Technical Analysts, and today I'll spend just 3-4 minutes here talking about this organization. This is a non-for-profit organization, and it's the Canadian local chapter of the International Federation of Technical Analysts. And being a non-profit organization, the objective is to encourage the development of technical analysis in Canada, provides a way to exchange information for the benefit of the members, and the objective is also to educate the financial community in Canada about the use of technical analysis in the investment and trading decision-making process. And of course, foster the practice of technical analysis in a professional and ethical manner as well. Now, the CSTA, the Canadian Society of Technical Analysts, will be at the Toronto Money Show, which is going to start this Friday. It's going to be for 2 days. Welcome, Nick Bahata. And it's going to be Friday the 16th, September 16th, and Saturday, September the 17th. There'll be a few speakers, and CSTA features leading experts. I'll be having a speech as well. And what is more important is that at the Money Show, the CSTA will also promote the annual conference. I'm very excited this year. We're going to have this gentleman. This is Leon Touay, who's really a myth of Canadian investing, and he's gonna hold to us a special seminar from Vancouver. This individual and appreciated veteran technical analyst, 55 years experience, and I'm very excited. We'll cover a number of topics. This analyst has been consistently been identifying lows and highs in the larger equity market. So that's something definitely to consider, and there will be also an intervention of this second expert. This is Andrea Unger, for those of you who never saw him. He is part of the scientific committee of the Italian Society of Tech Analysts and part of the IFTA, and he's the only one, he's the only tech analyst in the world who won for 3 years in a row the World Cup, Trading World Cup competition. And in 2008, he had an outstanding 672% return. He's also going to be the keynote speaker at this year IFTA conference in Australia. As I mentioned before, the Canadian Society of Tech Analysts is a non-for-profit organization. Everything goes to the fostering of the use of tech analysts among Canadians. And there are some benefits here. The most important thing is the membership, people you can contact and network with, market analysts, portfolio managers, traders, do-it-yourself investors, and students of the markets, as well as students, university students. And there are benefits. For me, the most important ones are networking, having the possibility to listen to speech from tech analysts, experts around Canada. There are chapters all over Canada which organize speeches every month, and this speech will soon be recorded as well. We also have Canadian Tech Analysis Hall of Fame, and the Technical Analysis Awards and Conference every year. And very soon, the Canadian Society will start recording each and every webinar and event in the chapters, and this is going to be very, very exciting. So this was a brief introduction here. I want to get into the assessment of the S&P500. The first thing I want to do probably it's look at the chart and what has been happening in the last week. I also want to take the opportunity to say hello to everyone. Thanks for coming and thanks for watching this video. And I'm going to switch quickly on the charts here. You should be able to see the charts on the screen. And what you see here, it's the SPY. This is the ETF that tracks the SP500 spot. And I usually track and look at both the SPY and the SP500 mini futures. Why they are important? They are more important because they represent different uses and behavior sometimes of markets. So I like to look at both of them. Now, before I get into details, and I will review the chart, this chart in detail later on, I just want to show you that we had last Friday, we had a big drop in the market, and after the market basically spent more than 1 month, I would say 2 months, in a lateral move here. And this that you see on the screen, just for your information, but again, I'll say something about this later on, are moving averages. They are EMAs. The red one is 13 periods. The blue one is 26 periods. And on this chart, this is a daily chart, you can see also the same moving averages from the higher time frame, which would be the weekly time frame, and you see them here. I'll explain you why these moving averages are relevant and how we can use them to see and wait and see where the market could continue or could stop. So thanks for joining. I have Pedro as well there. The event is live now, yes. That's correct, Likaba. So you can stay. So I'll try to make a point of where this market can go and what's going on. Okay, so that's my objective for the first part of this review today. The second part, I'm going to review some of the a group of forex pairs, particularly US dollar Japanese yen, US dollar Canadian, dollar and the US dollar Swiss franc. So stay with me. We're going to try to uncover opportunities in those markets as well. Okay, so going back to our presentation, let me present a few facts before we continue here. And so what's going on? Actually, the market is correcting, very probably. Now, should we worry? Well, it happens all the time. And some people might be asking, is this the start of a bear market? And if it is, what we should be doing? Now, to me, it seems unlikely that this is the start of the bear market. There is still a lot of things that need to happen. And in fact, we still have at least 3 areas of algorithms potential participation, and algorithms is usually associated with smart money. And I'm going to give you the levels that you have to keep watching here. And algos particularly will be looking at 2022, 1985, and 1832. And I'll show you how we can derive and use these areas as well. There are also 2 areas of dump money. Sometimes dump money is right. So sometimes dump money behavior corresponds to that of smart money as well. And we have 2 areas here, 2095 up to 2130. And these are levels in the S&P500 E-mini futures. And if you want to get the levels for the SPY, you can roughly divide by 10 and you'll roughly get the level for the SPY ETF. And there's a lower area that starts in 1940 and goes up to 2035. And this is on the monthly dump money here. And I'm going to talk more about this. So we had an initial move lower. We could be in a situation where we are going to have a 7% to 17% max correction here. And I see Nick and I don't see are in as well. And yes, we're live. So you can stay. And so this correction could actually end after 7% move or could continue for 17%. And I'll show you how I derived this these quantities here, these percentage moves. And so after that, we are likely to get a rally. Okay, we will get a rally even if this is the start of a bear market, because if you study the way the SP500 moves, the SP500 has upward bias, and the market just doesn't crash like it happened in 2008, where the market, the equity market, was anyway already into a move into the in a clear bear move. And we will look at that as well when we actually I can show this here very quickly because I'm sharing the screen here. And so when we look at the weekly here, we can actually see that after the first move lower here, we always get some sort of 50% retracement. And even after the market was confirmed here, the bear market in 2008 was confirmed, 2007, 2008. You see, we always had, and we had in this case, we had in the previous case as well. So it appeared we have a technical problem. Okay. Okay, so the sound is on. you hear me talking? Give me a yes if you can. It appears that we have okay, so you can hear me talking, but apparently you cannot see the video here. So I will let the FS admin check that. It's unfortunate because I actually so let's wait to get the video back. I mentioned some levels that you want to keep in mind and write down. Again, those are for the algos. The closest to current prices is 2022 level on the S&P 500. The next one it's 1985 S&P 500 E-mini level, which you want to keep in mind. And the third one is 1832. And if I had the you see in the charts here, I would be able to show you where they came from. They're not just okay. So all is good now. So should be able to actually see back the presentation here. Can you confirm that the recording is also going on? So as I was saying before, whether we don't know if this is the start of a bad market, right? I mean, we cannot know it, and we always have to anticipate that anything can happen in the market. But the way I want to comfort you is that, and I'm looking here at the end of 2007, so it appears that the video is playing on the YouTube website. And please confirm here that you're not having any problems. I will just continue here. So when we look at this price here, we always get a bounce. Okay, so on FS Street is not available, but on it is on YouTube. So please go to YouTube directly using the link that is being shared by the admin. Thanks a lot. And when we look at this, then you can see that even if the market confirmed the bear market and spent some time on the lows here, then eventually there was a rally. And I want to comfort you that this is a very typical behavior of the of this market, and you know it happens in some sort of form every time. And for example, we can see a 50% retrace here as well, and you will keep seeing this 50% retrace as a sequence in the market all the time. So that means that this market retraces a lot and also gives a lot of opportunity to take profits and then kind of reload, so to speak, if you are bold enough to trade shorts in a stock market. But see, when the stock market is in a bear market, that condition will continue for a prolonged time, and we saw this more than 2 years. 2 years and a half back in 2000, and we saw this for 1 year, 1 year and a half, almost 2 years here when we had the last bear market. And the crash area, if you wish, of the market it's really a portion of it. And even in this portion, I could show you that there were 50% retracement, and there was this first measure move, and if you look at this, we hit the first target, and then this market within a few days came back to test the next 50% here. So and again, the market then dropped for the next 4 weeks, and then again it came to very close to trade. Actually, I used the level, but I should really use the level that is actually traded. So when we use that, you can see that although only for 1 day, this market came and tested this level again. So this market moves in sequences of 50%. We do not have to anticipate something different. Thanks a lot for the help there. And so that's what we are looking to, that's what we are looking for. So no panic, there's no need to panic if you know what's going on. So let's look at then if it's the start of a bear market, what do we do? As I mentioned, after a confirmed bear market, the S&P500, I just showed you this on the charts, tends to retrace in sequences of 50%. I showed you in the last two bear markets. And I could show that on the previous market data as well. So these 50%, you often see them on futures. Sometimes you see them on futures and cash. I'm using the ETF SPY as a proxy for cash, but you can use the SPX as well, index, okay? And this is going to happen even in the most dramatic conditions. This market retraces quite a lot, and this is very important. Proof is in recent examples, and the confirmation came in on September 2000, as I showed you before, on both cash and SPY. On May 2008, cash and SPY. September 2008, SPY futures. Sorry, S&P futures. And mid 2008, October 2008, when we had that huge move lower on the SPY500 futures, as I just showed you now. Okay, so what to do? The market is correcting. To me, I believe it's correcting. It's not starting a bear market, but even if it's starting a bear market, this market will give a confirmation, and will be able to either unload stocks if you're invested, or even ride the market on the short side. So first of all, don't panic. If you have to sell portion of holdings that have appreciated a lot, or they are overbought, and you can use monthly indicators in order to identify that. It's not perfect, but that's a way to do that. And all that have seen their business grow, do not chase stocks. Do not buy at this stage. It might be too early, and anyway, that's always a bad idea. And the primary trend remains bullish, and I provided you those levels. Now I'm going to tell you how we derive those levels and why, and which are the areas you should be looking at. Okay, so at the end of the move, probably there'll be an opportunity to accumulate stocks, because this is probably not going to be the start of a bear market, but rather a deep correction. It could be deep. And from a seasonal point of view, it's aligned with the current seasonal indicators, and I'm going to talk about that in a moment here. Okay, so now I just want to switch on a recent article that was published on Zero Hedge, and this is from Goldman Sachs. Doesn't mean that Goldman Sachs hold the truth, but I believe that there are very good thoughts there, and it's good to review this very quickly. Goldman Sachs, it's not always right. Okay, so it doesn't mean that what is written here it's the truth, or it's necessarily going to up. But I believe there are some considerations here. Goldman Sachs also uses their own indicators, of which we cannot really comment a lot. We don't know how they are calculated, and we don't know what's the way they use them. But what is important, I believe, is to first of all remember that we don't have to panic. In the end, the market is still moving higher. The market moved higher because of fundamental reasons and not because of fear. And the market actually corrected due to mainly fear. Okay. Now, they in this article, Goldman claims 5 reasons why the SP500 should continue falling. And I will not comment on the first one. This is proprietary indicator they have for sentiment, and they say it reached levels that historically, the way they use this indicator has indicated a potential correction. Now, again, we don't know how this is derived, so there's not really a lot I want to comment on this. But what I want to comment on the other end is the second one, and this is basically a chart that shows the market uncertainty measured on a scale here from 0 to 180 as well as it shows the average, the median, and it shows the market uncertainty for 2016, which is this black line here. And what is interesting here is that in presidential election years, we usually get an increase, as you would anticipate and expect, of uncertainty through and into the election day. And typically the election day is the time when things calm down. And now this year it seems to be the results is still uncertain, and although a lot of people give Hillary Clinton for winner, we all know that the polls are actually shrinking, and there could be a surprise that now Trump could be the best surprise for the market, or the market could just react positively to his election as well. But it seems to understand, to me, it seems that an election of Hillary Clinton would actually be more in line with what the markets are looking for. And so what we have to think here is that we might see this market actually correct until the beginning of November, when the results will be in, maybe the first week or two of November. Okay, so there is political uncertainty, and this might be one of the drivers. As I mentioned, the corrections are always emotional, and this is one of the drivers here that we have to consider. A third reason is that, obviously, as you know very well, the economic data has been disappointing recently, the labor report, retail sales. And again, I won't comment on the internal indicators that they have, but the evidence we had from the latest news that actually probably also put back or had the Fed rethinking when they want to start raising interest rates as well. All right, so there is macro data here. Again, I will not comment on that. And I found very interesting that this fifth reason here, the equity valuation, remains extended. And if you look at what happened from 2009 to 2016, obviously the market has gained a lot, and the SP500 index trades at the 84th percentile of historical valuation, while the median stock at 98th. So this indicates that there are, we are close to, and we were close to, as this correction has started, to level where the market will correct. Now, let me show you how I derived these levels, and these levels are derived based on the methodology that I use, that is my FibStalker methods methodology. And I, just for the sake of curiosity here, I have on the screen one of the calls of that gentleman, Leon Tway, who's going to talk at the October conference. She had the chance to be in Toronto, make no mistakes, and buy the ticket for the conference. He's one of the best tech analysts that Canada can offer. Investors are fearful, very fearful, so be greedy. And he was saying that just 2 days after the low was in 2011. This is just an example, okay, just for curiosity. But what I want to touch on the other end is what this market is actually doing. So the way we've been modeling this market, and if you know my work, you know that I've been following this market and making these calls well before the fact. If you want to look at the calls, you can go back to the material on FX Street, and you will find these calls well before the fact. So we had algos participating at 1770, bringing price into the first target here, and then we actually traced again from highs to highs, just following our rules. And before the fact, actually several weeks before this market came back into this area, we actually knew what was the area to watch. The market retested twice and then moved higher, and then came again at the beginning of the year. Those who follow me will remember that. So from a weekly perspective here, algo and smart money supporting this price. Okay, there's no indication that the weekly actually have started selling this market. Okay, and the market can correct for a number of reasons. If there is no bid, the market will correct. If there are dailies or 4 hours of selling, the market will correct, even if weeklies are not doing anything. Now, of course, each trend, and this is a sequence here, and the previous level of the sequence is the one that I showed you before, is showing that this sequence is showing that this market is continuing higher or wants to continue higher, and I have no reasons to believe that that's not the case. Now, what I want you to take note of here is that within this move higher, we had actually an inner sequence, is an extension higher, which found participation in 1985. All right, and what it brought this price, it brought into the first target. So basically what I'm trying to say here is that algos participated, the weekly algos participated at 1885, 1835, and then dailies, they participated around 1985, bringing price right into the first target where profit taking has been happening basically for 1, 2, 3, 4, 5, and 5.5 weeks here, almost 6 weeks. Just Friday, then last Friday we saw this move lower. Now, as I showed you on the larger time frame, there are sequences also in the smaller time frame, and there are two levels that I want you to watch, and this is what the smart money, what the algos are telling us. Later on, I will show you also what the dumb money is showing us. Okay, now the 2080, which is one of the level 8085, which was the level I mentioned, would be a level where the daily would be tested. As you can see, this level also coincides with previous highs, but I believe it's not the previous highs that are important. The presence of this area of potential participation of smart money, it's even more important. Okay, they line up in this specific case, but more often than not, they don't. Another level that we have to keep into account, which the dailies are going to look at, it's basically a next extension long year, which comes at 2022. So 2022, as you will remember, is one of the levels I've indicated before. Okay, now what is important here is that there is a third level and third area level that identify the start of an area of support that also needs to be considered. So can you see how many areas potential participation from longs we have before anything happens? And only if price gets below 1934, I would actually start being worried about further move lower here. But in that case, even in that case, this market was still be correcting towards an area that was acted as a previous support before, 1835, and that's again why I have that level there. So can you see that there's no reason to panic here, because there are a lot of things that have to happen before we get there. Of course, you may say, okay, but if I knew today that the market had to move to 1835, then maybe I could sell short, or I could trim my positions. Well, we don't know that, and that's the only point. The stock market, though, the equity market, though, it's upward biased. So I'm very interested also in know when this market will stop, where it stopped, so that we can add to our position, or we can take a leverage position long, and we can do a number of things. Of course, if the market breaks the 1776, this is where I believe we would get a confirmation that the new bear market is in play. And so these are the levels that you want to watch. Now enter the dump money, and as I mentioned before, one way to model dump money is to look at moving averages, and I hope I do not offend anybody. They can be a great instruments, but the way I use it is to model what some of the participants who can actually have a sizable effect on price will do. And as you can see here, these areas between the 13 EMA and 26 EMA, 13 is the red one, 26 is the blue one here, area that I call value areas. And indeed, this is not a new, this is something that was introduced by Alexander Elder. I'm just borrowing the definition here. The point is, the good and interesting thing is that very often when price gets into the value area, either of the weekly value area or the monthly value area, which is the area between these two, red and blue, then you will see some sort of participation. And we saw this here, and we saw the participation after the market entered the monthly value area back when we had the Brexit. This was, as you will remember, June the 23rd. So June the 23rd, the Brexit was not only more than an opportunity for the market to get into a monthly value area, where buying the market can be very profitable. So what the market is telling us here is that it's into this value area, and it is possible that it's going to lose this value area. But look at where the other levels are. So I will remove, for simplicity here, I will remove that level. But we have seen here that we have, and I will also remove this level here. Okay, we have seen here that there are two levels that are watched by algos, 2022 and 1984, which are within the monthly value area. Now, look at what happens when the market gets into the monthly value area, and it's not important even if it closes below the blue line. It doesn't matter. What that indicates that there is a lot of fear in the market. Okay, and Learn 2A put it back very well here, and we very well know that when investors are fearful, when everybody is looking for even lower prices, then that's when you have to be greedy. And it happened twice in the last 2 years, beginning of 2016 and then back August and September 2015. But you will see that every time this market gets into the monthly, weekly area, very often that's an opportunity to get involved. Again, we have to go back to 2012. That's why you have to be also very careful in shorting the equity market. The equity market is bullish biased. And again, that happened again in 2011 here when Learn 2A came in, and again at the end of 2011. And we see this kind of behavior a number of times. Now, to me, it's much more important and relevant when the monthly 13 is above the monthly 26. Okay, and although this applies on the short side as well, but I don't want to focus on that. We saw this behavior also in 2003. Every time the market got into that value area, very small here, because the market just, the crossover just happened, here again, and here again, and here again. Every time the market gets into this area, very often that's a good opportunity to buy. And let me tell you that even if you bought here when the market was, and the confirmation of this bear market came basically this week here. So even if you bought here, the market gave you, if you were capable of waiting and without panicking, gave you an opportunity to exit even with a profit and then establish a short position. Okay, so that's why before in my presentation I was a little bit kind of provoking here when I say don't panic. We all have time, right? And this is very common. It's not only the last 15 years history of price here. When we go back, study previous price, the last 115 years, we saw this kind of behavior at all times, all the times. Okay, and again, if we go back to the previous bull market, I don't have a lot of data history here, but again, you'll see that every time the market gets below that area, the value area, and we have the 13 above the 26, then that's an opportunity to get a rally, again, rally, again, rally. And now, if you're investing, you don't have to be precise, right? If you buy here instead of buying at these lows, yes, you will need to bear a 5% or 3% move lower for stocks that have higher beta, maybe a 10% lower. But if you're investing, you should not be worried about that, provided that the stocks you select are, have a potential and they're in a good business, the business is in a good shape. Okay, so and I'm not trying to simplify things here. I'm just saying that this market might get into a value area here, which is also aligned with interest of smart money, and only if we get a consistent move lower throughout the beginning of November, we are going to get into troubles here. Now, just like to ask Yadmin if everything is good. We're still on and we're still recording, or we see that the video is available on the available back in the FCB. So we're still on here. All right. So this is what I wanted to share about this market and why those levels I gave you are important and what you have to anticipate in this market. So don't panic. This market might well resume its move higher in November after it gets into the 1985 area, and it can get as low as 1934 and everything be still intact here without problems. And we have seen before the market dipping below to 26 and then nicely recover. So if you are bold, if you're aggressive, one way to play that is to actually add to your long-term stocks or even buy a leveraged ETF, because if even if the bear market has started, we should have an opportunity to exit even with a small profit if the bear market is started. I don't think, but my opinion, it's the value of my opinion, it's 0. I don't think that we are going to. We have started a new bear market. The algos on the very large time frame monthly that participated in 2009 are looking for 2400, and we have not reached that level yet. So that's another reason why I don't believe that this market is going to, this is the start of a bear market, all right? So let's say there is one last comment I want to do, and this is very important. Whenever the low will be in, and this is very key information for your timing as well. Whenever the low will be in, and we will not know when the low is in, right? So let's go back to, for example, the low we have seen in the low we have seen here in back August end of August last year. Obviously, if the market gets to the lower edge of this band here, identified by the 26 EMA, I will be prone to buy, because even if the market drops below this level, we should be able, due to the tendency to reverse within the S&P500, to exit even with a profit disposition. Of course, we should manage risk in the right way. It's not something I want to discuss now. What I want to discuss is, as I mentioned before, the moving average acts as dump money, and now, if you remember what we said before, is that we had we had on this chart, we had basically traced from the highs to, sorry, it was from the highs, and this is not a random level, okay? Highs to highs, and this is not a random level, because this is the high on the future in 2000s. Okay, so it's not a random level. There are rules to trace these moves here. But the next measure move, I want to show you an example in which the dump money does not agree with the smart money, and that's something that I can show here. And as you can see, one important thing I want to show here is that the smart money is saying buy, and then the dump money, which is represented by the value area short here, is say sell. And they're both right, but who's going to win? As soon as the market moved lower into that 1835, then there was another participation. So this can be a useful behavior to identify the bottom as well. Of course, if the market gets to 1940, I believe that would be a good place where to add to your stock holdings, as well as maybe even start taking a small position on a leverage ETF long. But what could happen is that as this market moves lower, this moving average will cross over, like it happened in this case. And this could create a short value area, whereas as soon as the market gets into it, we see dump money selling. Dump money might not know that there may be a renewed commitment by smart money, by algos. And again, that commitment might come at a level that I gave you before, which is this one, 2022. So if it comes from there, or even lower, right? We mentioned another level, which is the 1935 here, sorry, 1980, 85. So if participation starts in this area or in this area, anyway, starts within the area of the monthly value area here, you have to watch and look at whether we have an opposing value area on the daily, which has the potential to push down market for 1 week or even more, and push it back into where smart money would participate again. So this is very interesting, because it gives also smart money the opportunity to buy again at lower prices. And so in a way, sometimes smart money on the smaller time frame facilitates this behavior. It's very, very important. Okay, so this is very important because if the market starts rallying and hit a value area, then you can wait to add to that position and wait for the market to retest that area, the value area, and continue higher. Okay, so I give you a key here and a methodology that you can use in order to understand where the market and if and where the market can stop. Of course, this market can actually in the short term come and set up for a 50% shorts here. Notice how on the daily time frame, the daily value area has already converted to shorts. So if this market moves into this 50% 2142, there will be an opportunity to sell this market potentially into 2080 and even lower into 2045. That brings our price close to that 20 and 1985's levels that I've showed you there. So obviously algos on the smaller time frame participate and work together, as well as dump money in the smaller time frame actually acts whenever they feel compelled to act. And again, if this market in the short term, if this market gets into 2142, I would consider that a level to short. And as you can see here, in this specific case, dump money would be aligned with the smart money in selling this market. And when everybody agrees, the probability that this would follow up, it's higher. So 2142 level, and this would be in the SP500. Let's see, the SPY ETF. This would probably be something around the 216 level here. This would probably be a sell area. Now do your research, mind risk. I always take position by knowing how much I'm risking, and I'm always willing to take the risk. If it's too high for me, I lower the position. I lower the position size. So this is another recommendation. This is a way of studying the way the market behaves. Okay, but I personally, I would be ready to actually consider adding to my shorts at that if that happens. Now, that is also how on this time frame and on this market, the SPY ETFs, the 13 EMA is acting as resistance. All right, so apparently this review of the SPY and SP500 took more time than I had planned. So what I promise is that I'm going to do a review of those three markets: US dollar, Japanese yen, US dollar, Canadian dollar, and US dollar, Swiss franc. And I'm going to publish the link to the YouTube video here, because I'm not sure whether we will have time for that. But if the FSC admin confirms that we have more time to cover briefly the other three markets, then I would be happy to do that live. All right, so if you can let me know whether there is another webinar after me today. Otherwise, I will just continue, and with this, I will end the first part of this review. And in this first part, we actually covered the assessment of the SP500. Before I go and I start the second part, I would like to remind you that I'll be talking at the Toronto Money Show. And if you're not able to be in Toronto this Saturday, you can always register online, and you can go on torontomoneyshow.com and register there, and you will get the recording of the presentation. All right, so, and now I'm going to start the second part of this review. And as nobody's stopping me, I will continue here. Desi, please confirm. And I promised that I would review the US dollar, Japanese yen, the US dollar, Canadian dollar, and US dollar Swiss franc. And I like to do that by so I like to do that first of all, as I always do. I want to review long term what's going on the weekly first. I will start from the weekly here, and I want to review the trend following indicators here, mainly those values, those levels that give us the value areas. And those who follow me, and actually you traded this market successfully a lot in our FX Street open room, the Tokyo open room in the last at the beginning of the year here, and in February we took some trades. Those who follow me will remember that this market was in an extension trade, the first and second target, and then we actually started following the inner sequence of measure move here, and this was beautiful technical market. We had a 50% when the first target, but not the second target. So we actually traded and looked at the longs here into the first and second target. So this market then started trading in extension here after they hit that second target, and we saw this market participating again around that second target of the previous measure move twice, pricing to the first target. Similar situation as we could be getting here on the SP500, same high, new high that held, as we saw here in August, but then eventually he broke, and we can get this break of only one pip, and that's good enough. We know that algos are not more willing to trade on the long side, and in fact they started trading on the short side. And market went into the first and second target, and all this I'm showing you after the fact. Actually, I have anticipated all this before the fact, and you can review my previous presentation. I gave all these entry levels well in advance, and the market then continued lower and traded the next extension here. I gave this in one of the premium webinars. I gave the next measure move, which came with the market went into the first target, did not continue to the second target. So again, we use same anchor to new low, and we got that as well in another premium webinar. And market went into the first target, and look at the beauty here, how the day of the Brexit, the market used that opportunity and that excuse. Algos used that excuse to push market into that second target. What a beauty. Not only that, but this was also the trend continuation area of the long that started in 2012 here, and we have seen this market confirming this area now for the third time. I don't believe this market is gonna move lower. Now look at the beauty here. When we include the dump money here, what we can observe is that this dump money was online and inline and agreed with the smart money in these longs, and the larger monthly on this long here. But then we could also see that they agreed on the shorts here that we saw before. The smart money was looking at this 50% level, and the dump money was looking at that value area. Notice how the market did not stop at the value area. He had to go into the level, and only when the smart money came to play, this market started moving lower. The same thing happened when the market touched the weekly value area short here, and again it came into the weekly value area short here, and now this play here of the weekly which started in July 22nd here, which moved very slower into again what? So this was a dump move here. Why? Because the bulls had already confirmed they're willing to. The smart bulls, they already participated into the longs here once and twice. Now, when the bears and dump bears have moved this price back into this level. There was again another participation. And again, see, in this specific example, you can appreciate the importance of being on the right side. Now, yes, the bears are being successful in pushing this price lower in the short term here, but will they have success in the medium intermediate trend? Well, I don't believe so. And this chart is already showing that the dollar index is probably going to move higher. The only thing that is actually keep this market lower, pushing this market lower, is this participation from dump money, which is here modeled. And again, no offense to anybody. It's just the way I consider the areas, the value areas between these two moving averages here. And I believe that this market eventually is going to win the resistance that we get from dump money and start moving higher. That move has already started. And this could be the main play of the dollar index, and so also the US dollar Japanese yen going forward into November. And what I know from the analysis of the participation of algos and smart money is that this market has the potential to revisit 112.43, and only then we will see whether smart money wants to keep pushing this price lower or will actually let this market continue its move higher. So if that's the case, you're going to see a development that might be similar to what we saw in 2013, 2014. I've been following this market since 2012 using these methods. So that's something that I have a lot of experience and time spent on this market. Now let's look at the US dollar Canadian dollar, and again I want to look at the smart money first, and then I want to look at the way I model the dump money. And this market has been moving higher. We were all, including myself, looking for this market to retrace into the highs here. That didn't happen, but in a way that's only something that can happen if it's supported by price. And what we saw here, for those who remember this, the way I model this market is an extension. And again, this can be modeled before the fact, because the way I use these methods is that I trace from the lows to any new highs that is printed. And when the new high is in, like in this case, then this level never changes. So it means that this level was there 1, 2, 3, 4, 5, and 6 weeks in advance before it was tested. And this is very important. So the market got into the first target. There was some profit taking, which was again a confirmation this area was a valid one, traded by smart money. And then the market got into the second target and continued higher. So the way I modeled this market was again from highs to highs, and we got participation. I also got involved on the long side here. For those who want to look at the again FS Street Toronto Tokyo Open room, you can look at that. But after that, we had a break of this level, so there was a confirmation that the weekly were not willing to keep pushing this price higher. And after that, we had this market basically started moving in extension lower, and at some point we identified an extension long. Now, someone could claim that the previous high is being used, but as you can see, that was broken, so that's not a valid. That's not a valid. There's not a valid trace. And it's really not important what is pushing this price higher at this moment. What is important is that there is a group of participants that eventually pick this market higher, and the shorts here are still, and the bull here is still in the bull's court here, because the short have to prove themselves that this market actually that the bulls actually have enough strength to keep pushing this price higher. So above 134.23, if there is a continuation higher for this market, what I'm looking for is the although if we back here the 50% level, which is always an important level to test, 135.75. Okay, so apparently the bulls that keep pushing here, there was participation in this area. This area 126.60 came into play here again to almost to the pip, and now this market pushing higher. So the dollar index, as you can well imagine, and I made a review of the dollar index last week, and that's still valid. So you can review that video. This is last week's video. It was on Thursday, and you can find it. You can find it on FS Street if you go to 1 week ago live video. And that's still valid. As you can see, the 94.50 is holding here, and that's our anticipation for the continuation of this market. Finally, and again, if you have any questions, please you can write them down, and you can also write your question at fibstalker@gmail.com if you wish, and I'll be happy to provide an answer to you. The last market I want to review in this group is US dollar Swiss franc. Every week in the continuation of this show, which is going to continue every Wednesday at 7 p.m. EST, I'm going to review a different group. So this week I reviewed the US dollar Japanese yen, Canadian dollar, US dollar Swiss franc. Next week I'm going to review the 4 markets that you see here. So if you're trading these markets, come on the show, and I take questions as well. So the US dollar Swiss franc here, of course, we had that ugly move, something that the Swedish, sorry, it's not the Swedish, of course, it's the Swiss central bank doesn't want to repeat, not to lose credibility more than what happened. And you know very well that this move lower also caused some problems with some of the some brokers, forex brokers, and it's really annoying to find your account to be cut because of something like this. Now that didn't happen to me because our model was cash in this case, but it would have been very annoying and potentially, treating it for the account. But after that happened, after a few days, this market went into 086.52, and till that point, this market has been moving higher or laterally recently, and we have a target at 109.88. Now, will it get there? We don't know. What we have to do, or what we can do, is to analyze this market and see what has been happening. As we know, based on our models, this market has been lateral on the weekly on top of that support here, and so bulls failed here, bears failed here, and then bulls actually succeeded here on this 092.89 level, as you can see here. And we always test these levels. We never trade this level blindly. But this is showing that now there are 2 group of smart money which are supporting this price into that intermediate target 105 from this setup here, and price never got there. And there is also the larger time frame here, which is obviously pushing price even higher. So this target here would help price move higher. So if the dollar index moves higher, and it appears that that's what's doing here, there would be, so if risk is off on equity at the moment, money will get into the dollar index, which is still considered and still considered safe haven. Some people might say, which basis? When we review the commentary of the like of Peter Schiff, as well as Zero Edge and a number of other authors, we know that there is a lot of negative thoughts about the quality of the recovery in the US economy. As I mentioned in the past, price is all perception as well. Sorry, not price, but really perception of the real problems. Those problems might be there for years, for months, or even years, and nobody notices them or believes these are real problems. And only when they become, only when the perception is clear that those are problems, then that shows in price as well. Now, going back then to this market, there is this 92.89 long, and after we got this long again, we got a market where bears have failed here, and after that, bulls have failed too, and that's here. Okay, now one could also argue that bears are in control on the daily at the moment and might be pushing this price back to 92.84. That's not going to happen if the US dollar is actually, index will continue higher, and this has the potential to bring price above 99.96. There is the potential for price to get into 105.45. Okay, so that's the way I do my analysis. My analysis is based on the FibStalker Metals Coaching Program. Again, if you are able to join me in Toronto, you can come on Saturday, 1:15 to 1:45 p.m. Saturday, September 17th, at the Toronto Metro Conference Center. And if you cannot, you can still take advantage of my presentation and the presentation of a lot of other experts at the Money Show by just registering online. And if you are kind enough, I would like also ask you to tweet that you're going to participate or you registered. All right, so okay, so this is it for today. If you want my contacts, I can provide my contacts in this presentation. I'm drawing extensions from previous highs, yes, from the highs in 2000s for the SP500 futures. That's not a problem. You can go on. I have a lot of open webinars on FS Street. Just look for my name, and I have free webinars where I explain also the basic moves, how I trace them, and the logic behind that. Okay, so I don't see if you want more information, there will be no time now. There is a logic which is based on the use only for Fibonacci levels, and I actually let me see if in this presentation I have. If you write to me anyway, FibStalker at gmail.com, I can provide that. Let me see if I don't have it in this presentation. So I might have it in a different presentation, but you can find it online. If you have any problems finding it, just shoot me an email and I'll be able to send you the links, okay? It's plenty of information. There are probably almost, well, more than 15 open presentations that anybody can watch. You don't need to have a premium. Of course, if you have a premium, it's much better. I also do a monthly premium webinar as well. But all the information you need, I can tell you, it's there, and it's very clearly explained with a lot of examples as well. It shows also how these models have have worked in the past and why algos modeling something fundamental about the market. Okay. If you want to be in contact, write me an email. Please tweet. If you can register, I would appreciate that. And I'm on my website, and there is also a lot of free information on my website. So have a look at that as well. Okay. So thank you very much. Thanks for your attention. And again, I'll see you next Wednesday, 7 p.m. EST time for the FibStalker FX Street weekly show. All right. Thanks a lot. Bye-bye now.